Hi everyone, Nick Reiland here with Vantage Point Financial. I want to take a few minutes to review the second quarter, the first half of 2026, and what it means for your financial plan. For anyone who may be newer to Vantage Point, we are a comprehensive, team-based financial planning firm. We help families coordinate the major areas of retirement: income, investments, taxes, healthcare and insurance, and legacy planning, so those decisions work together instead of living in separate silos. We serve as a fiduciary, and our job is not to react to every headline or pretend we can predict the next market move. Our job is to give you clarity, help implement the plan, and make thoughtful adjustments as your life, the markets, and the tax environment change. With that in mind, let's look at what happened, what it reinforced, and what we're watching next. The first half of 2026 gave investors a full market cycle in a very short period of time. Markets began the year near record highs. Then, in late February and March, conflict in the Middle East disrupted energy markets and pushed oil sharply higher. Inflation concerns returned, the news became increasingly unsettling, and the S&P 500 finished the first quarter down 4.6%. Then the story changed quickly. A temporary ceasefire eased some of the immediate pressure, oil prices retreated, earnings remained strong, and markets rebounded. The S&P 500 gained 15.2% in the second quarter, its strongest quarter since 2020, and finished the first half up 10.2%. The key point is not the exact headline. It is how quickly markets moved. The trip from fear to recovery took roughly 10 weeks, and the market began turning before the news felt comfortable. An investor who moved to cash after the frightening headlines would likely have missed a meaningful part of the recovery. The rebound was also much broader than just a handful of large technology companies. In the second quarter, small caps gained 21.5%. Emerging markets gained 24.1%. The NASDAQ gained 21.4%, and international developed markets gained about 11%. Zooming out makes the lesson even clearer. International stocks led in 2025. During the first half of 2026, small companies and emerging markets led. Even within the S&P 500, leadership rotated again, with industrials, technology, and energy among the strongest areas. No one consistently predicts those rotations in advance. That is why we build diversified portfolios and rebalance with discipline rather than chasing whichever investment performed best last year. Diversification does not eliminate volatility, but it gives us multiple ways to participate when leadership changes. Bonds quietly did their job. The Bloomberg U.S. Aggregate Bond Index was modestly positive for the quarter and the year, while today's higher yields continue to provide more income than investors received for much of the last decade. That is helpful for retirement planning and for the conservative portion of a portfolio. The Federal Reserve held its target rate at 3.5% to 3.75% through the first half of the year. The Fed is balancing slower job growth and economic uncertainty against inflation that remains above its long-term target. The economy also continued to grow. The official third estimate shows first quarter GDP growth of 2.1%. Unemployment was 4.2% in June, headline inflation fell to 3.5%, and core inflation was 2.6%. June's monthly decline in prices was largely driven by falling energy prices. One statistic captured the emotional disconnect. Consumer sentiment reached a record low in May, yet the stock market was reaching records only weeks later. Feelings are real, but they are not forecasts. One part of our process that is especially relevant during periods like this is the bucket plan. The bucket plan organizes retirement assets by when the money will be needed. The now bucket is safe and liquid. It holds money needed for near-term income, emergencies, and planned expenses, generally in the next 12 months. The soon bucket is designed for the next several years. It is usually more conservative and income-focused, creating a buffer so you're not forced to sell long-term investments during a market decline. The later bucket is money that should not be needed for 10 years or more. It can remain positioned for long-term growth, inflation protection, and legacy goals. The buckets are not separate plans. They work as one system. When markets are strong, we can deliberately replenish the now and soon buckets from the later bucket. When markets are weak, the near-term buckets give the later bucket time to recover. The purpose is clarity, knowing what each dollar is for and when it may be used. The bucket plan is one important part of a much larger strategy. Our elevated retirement plan connects 6 key areas: your goals and concerns, retirement income, investment management, tax management, healthcare and insurance, and legacy planning. We don't believe an investment portfolio by itself is a complete financial plan. A portfolio can perform well and still create problems if withdrawals are poorly timed, taxes are ignored, healthcare risks are unaddressed, or estate documents and beneficiaries are not coordinated. Our role is to help bring those pieces together, show you the evidence behind each recommendation, and help execute the strategies, not simply hand you a report and a list of things to do. The plan is also flexible. As your goals, family, tax laws, or markets change, we revisit the assumptions and adjust deliberately. That ongoing process is what creates clarity and confidence. As we look toward the second half of the year, we're watching several things, not making predictions. We are watching whether the energy-driven inflation pressure continues to fade and how the Federal Reserve responds. We're watching the Middle East and the effect that continued tension could have on oil prices, inflation, and confidence. We're watching corporate earnings and whether the large investment in artificial intelligence and infrastructure continues to support economic growth. And we are watching valuations and the additional policy noise that often comes with a midterm election year. None of those items leads us to make an all-or-nothing market call. They help us evaluate whether the assumptions inside your plan remain reasonable. If the evidence changes, we adjust the plan thoughtfully. We do not make emotional changes simply because the headlines are loud. The first half of 2026 was a useful reminder that uncertainty is normal, leadership changes, and recoveries rarely wait for investors to feel comfortable. The goal of planning is not to eliminate uncertainty, it is to make sure uncertainty does not control your decisions. Thank you for the trust you place in our team at Vantage Point Financial. If the first half of the year raised questions about your risk, retirement income, taxes, or any other part of your plan, please reach out. And feel free to share this update with a friend or family member who could benefit from a steady, plan-first perspective.